I think there's like the prime example of like if you're a hairdresser, you're a landscaper, you're, any type of service industry, independent contractor, so that 15% self-employment tax just crushes.
I'm like, I legally pay no taxes. And it's like, how?
Yeah.
That's when starting to invest in front-loaded depreciable assets, such as mobile home parks, starts to become so advantageous for someone who's trying to lower their tax load as well as generate net worth and cash flow. That's really like the magic right there. Is if you own a business, you own rentals, your wife qualifies as a real estate professional, you've kind of have set yourself up to where investing in any real estate becomes a no-brainer.
Welcome to another CashFlow Quest episode. We're going to have some fun. I think we're going to get into some little arguments and have a good time. We're going to do a broad tax strategy conversation because it seems I was in the river for Father's Day, and I was at some point, I had like 3 or 4 business owner guys around me asking all these tax questions. And it's kind of interesting. And Ben and I have laughed about this over the last couple of years that we've really become like tax planning advisors. We're no CPAs. So full disclosure, anything we say here should not be taken as hardcore fact.
We're not certified financial planners. We're not CPAs.
Because most of the time it depends, on how you're structured and so forth. If it's like a very specific tax thing, you should go to your CPA. This would be a good place to get some ideas because we're going to cover some different structures. A lot of the questions that we get from people ongoing, if you're an LLC, if you're an S Corp, if you're a C Corp, like things of that nature, we'll cover. But then you want to take your scenario and run it up the flagpole with your CPA.
I think we've had a lot of experience with all of this stuff. And so it'll be fun to kind of chit chat through different scenarios that hopefully will give you guys ideas or new ideas to like bring good questions to CPAs or financial advisors to help you guys not pay taxes and make more cash flow.
Yeah. And I would just say like the best thing to do is ask the question to a CPA or financial advisor. 100%. So that's what I always just question.
You don't know.
Exactly. When I'm having conversations with people, I'm like, hey, all right, here's what I would do, but frame this and ask your CPA, because as much as people think that a CPA always has your best interest, which is true, for the most part, they're not going to be proactive and give you strategies. 100%. Most of the time, they're just filing taxes and saying what you did, what can we write off, and that's it.
And the questions they need to know to file your tax return correctly and properly. And sometimes they don't know what your goals are or what you're trying to get to. So then they're, to your point, they're not going to be proactive in asking you those types of questions. You have to most likely bring questions to them. Then they'll have lots of information and answers for you.
Let them be the guardrails. You know what I mean? So posing the question and then let them be the guardrails to tell you yes or no, or maybe, and then maybe let's go explore. And how do I get there?
I'll kick off. I'd say the most frequently asked question for me is, I have a small business or a I'm going to call it self-employed business where you are the boss and you run a company and you make a good living. And so you make a lot of top line revenue, and you're got a decent amount of profit at the end of the year, but then you're looking at your end of the year tax planning with your CPA and you're getting punched in the stomach every year.
Yeah.
And it's kind of like, oh man, like you're just not able to really stash that much money out of your profit aside without getting, that 30-40% hit on tax. And so I tell my first question for somebody that owns a business is, are you like a service-oriented business? I'll give you an example from this weekend, which was a landscape contractor that has been doing it for a long time and done really well and doesn't want to change businesses, like is happy. He's got a good business. And so it's like, okay, what can I do now to kind of go to the next level and plan for the long term? And so my first question is, what's your business structure? And typically it's an S Corp or an LLC. And an S Corp is better for service-oriented businesses so that you can put yourself on a reasonable salary, look up reasonable salary with quotes around it. And you'll learn that like you can kind of play the game there on how much you put yourself on your own payroll for the W-2 withheld taxes.
And I'm going to insert there too. Sometimes when it's not held in an S Corp, and held, but in your name or
Sole proprietor,
the sole proprietor,
or an LLC.
1099, like independent contractor, you pay self-employment tax.
So if you are not a S Corp and you're not on your own payroll of your S Corp, you are going to be paying self-employment tax.
You pay tax on the revenue and self-employment tax. So it's like double tax, where the S Corp kind of structure then eliminates that self-employment tax piece. You're still going to pay taxes on the revenue. However, the self-employed or the S Corp structure, you can minimize your bottom line revenue, your net revenue with all the expenses, including a reasonable paycheck to yourself and stuff like that. So that eliminates self-employment tax and minimizes the net income from the company.
And it's intended as a structure for small business corporation. So that's why it's called an S Corp. And that's the key, is to make that designation. There's a way to have an LLC and designate it as an S Corp, but it isn't as clean from an audit perspective. I think from the CPA guidance, I've always heard you'd be better off to operate under an S Corp and then own like your trucks and your tools and all of your equipment, airplanes in an LLC. And that way you own assets in an LLC, you operate your service-oriented business with revenue on an S Corp. And I'd say that's the big thing, to just change that and probably save 15%.
At least, because the 15% is what the employment, although is that what it still is, guys? It used to be 15%, the self-employment tax.
Well, yeah, I'm pretty sure.
I'm pretty sure.
It's within.
Yeah.
Well, my wife, she has a service business. She made 120 and she paid 40 in taxes, and 15 of it was her self-employment tax.
So there you go. It's maybe under 15%, but 15 grand.
So I think there's like the prime example of like, if you're a hairdresser, you're a landscaper, you're, any type of service industry, independent contractor, so that 15% self-employment tax just crushes.
But she had deductions too. So I'm pretty sure it probably is close to that.
More. It was maybe more on a percentage basis then. Yeah, maybe closer to 20. So for fun, when my wife did hair and was doing well, she did the high end extensions, this and that. My S Corp was a real estate investor and a hairstylist. And I wrote it in the bylaws.
And that is totally what they're for. You can have a husband and wife in the same. If the husband has a service industry, business where they're making money and the wife's also doing something, you don't have to have two. You can have one and funnel everything through that one in that situation. So there's lots of ways.
Yeah. And it's even if CPAs were to fact check us, you should fact check everything we're saying. And then it's not, I can't do that. It's how do I do it?
Yeah.
That's the key, is like, don't just cross it out indefinitely. It's like, no, how can I tailor my life to pay less taxes?
Or what do I need to change?
I think right now would be a great place for some foundational background, because a lot of investors, they go to a big group and they're going to be told about the tax triangle, and they're going to say, well, real estate's a taxable triangle. So like, how are you helping me? And I think that's what's really special about manufactured housing and some of the cool things that we do with depreciation. So maybe give some foundational, information for someone who's like, okay, I get that. I don't want to pay more taxes, but how is this company going to help me with manufactured housing?
That goes to
the next step.
The real estate professional designation was probably one of the best things that I bumped into, asking like 10 stupid questions, one after the other on one of our calls where we were at the end of the year and we were going to pay a serious amount of tax.
I think you were listening to a book too, and you like had to rewind like 6 or 8 times because you're like, wait a minute.
So Robert Kiyosaki in one of his books said, I make money educating people. And then with all of my profits that I make from my like marketing educational business, I invest in real estate to legally pay no taxes. And I'm like, I legally pay no taxes. And it's like, how?
Yeah.
And I literally,
let's figure out how to do that.
I'm like, our guy's name at the time, I'll just say his first name, Ken, was our CPA at the time. And he goes, well, gosh, I don't know, unless he was a real estate professional and he could offset. And he's just kind of thinking out loud with me. And I'm like, well, hold on. What's that? What do you do for that? Oh, you just check a box on a form and send it in. And then you have to have, it's like half or more of your professional hours in a given week or a given month throughout the year has to be in the management of your real estate assets or real estate holdings or in property management. And there's a kind of a whole, formal distinction for that. And I'm like, well, hello, like all we do is manage real estate and buy more and raise equity. Like, wouldn't we qualify? And he's like, hold on, let me think about this. And he was still like, that's the key, is knowing, like giving your CPA enough context to actually help you. Because they just get a bunch of documents on their desk and they have another 100 clients like you. So you give them enough context. Well, then we figured out we could.
So to slow it down just quick, it's called the real estate professional election. It's an election that you make on your tax return every year. And your CPA will help you make sure that you qualify annually for this election that you can place on your personal tax return, whether it's, jointly or individually. And so talk to your CPA, ask them if you qualify, but there's lots of ways that you can qualify for this designation. We qualify because we manage real estate and buy mobile home parks every day, but you can own rentals, you can have pieces of other real estate holdings and quote, manage it. There's lots of ways. So ask the question.
That's the CPA. That's the focus on how to change your life to end up there if you're going to play in the real estate game long.
So go ahead, Tide.
Well, maybe you're a plumber or a general contractor, but you own a rental or two and you're investing in mobile home parks, and wifey is spending half of her time managing these things.
100%.
So
if she's a stay-at-home mom, she could designate some of her time to manage these assets and qualify. And so then I think now we talk about why that's so important and why we like it so much.
Yeah. And I think too, just like making a distinction there and like putting a finer point on what Ty just highlighted, because I talk to people all the time about this situation. So if you have a W-2, so you and your wife, you have a W-2, or let's just say you're not married. If you have a W-2, but you own rentals, you're not going to qualify for a real estate professional, because the IRS is basically going to say, there's no way you spend more time on these rentals than you spend on your W-2.
Right.
So that is kind of a wash, right? But to Tide's point, if you're a business owner, right? So you own this landscape company, and like many people do, you have some rental properties.
Or your wife does hair or something where they're not a W-2 full-time employee.
Yep, exactly. And in that scenario, what you'd want to do is say, okay, honey, look, you're already doing this already. You're managing, you're dealing with the lease ups and all of that. Most families that I talk to, this is what usually happens. The wife takes control over most of the rental properties from that standpoint. So the first thing that you need to do is talk to your CPA and say, would we qualify if, let's just call her Jen.
Yeah.
Jen
and then
qualify, or as
we qualify?
The real estate professional designation, when they're going to sit back, and if they're a very conservative CPA, they're going to say, I don't know. Are you spending 750 hours on it? Well, then the next point is like, you're going to try to then go back and try to find hours. The way to do it is you're proactively setting up like a shared Google Calendar.
Right.
And every time you're at Home Depot, or every time you're driving to the rental to pick up the checks, or anytime you're speaking with a property manager, or you're looking at furniture for this rental,
buying
or whatever it is
for the rental,
start tracking those hours in a Google or some other calendar, and start blocking time.
Yeah.
And then
taxes.
look back and count your hours.
Yeah.
And I guarantee you it'll be 750 hours or plus.
In
a year
750 hours.
It sounds daunting, but when you divide it by 52 weeks, it's under 15 hours. Basically, call it 15 hours a week.
Yep.
And then I was going to pull it up just to be sure that
Paying your property taxes, doing the insurance renewals.
Taking the check to the bank.
Yeah, exactly.
Yeah.
Filing
you
taxes.
got to walk to that bank.
Right, exactly. You could, an hour at least.
but that's the way that, so once you kind of set up your structure in that way, then I'm sure Blake will take it to this next degree. That's when starting to invest in front-loaded depreciable assets, such as mobile home parks, starts to become so advantageous for someone who's trying to lower their tax load, as well as generate net worth and cash flow.
Exactly.
As well, passive cash flow, to then help, sustain income while you're still working, but then hopefully get to the other side of the hill when you hang up the boots, to then be able to live off of that passive cash flow And then maybe you have a double whammy where you're able to sell that business at some point and you have some excess, liquidity or capital to then decide which you want to, what you want to do with that. We could start to talk about that. But that's really like the magic right there, is if you own a business, you own rentals, your wife qualifies as a real estate professional, you've kind of have set yourself up to where investing in our space, or really investing in any real estate, becomes a no-brainer. And let me just put numbers behind exactly what I mean by this.
Yeah.
So say you qualify as a real estate professional, and let's use that the big, beautiful bill does pass and the 100% bonus comes back.
Yes.
Say you invest $1 million into one of our deals or any other mobile home park, right? You buy your own. It doesn't have to be with us.
And you do a cost segregation study.
And you do a cost segregation study, and we could talk about what that is.
Yep.
Should.
Simple math is that you're going to get, if it's 100% bonus on your K1, and just having done this for a long time can back it up with facts, you should get about a 1-to-1 loss. So on $1 million investment, you'll get $1 million in year one losses. And I could talk through why that is. But if on $1 million investment, you'll get $1 million year one losses, which is just startles people. They're like, that wait, Ben, how do you get that? And then I back into exactly how that happens. So say you invest $1 million into an asset that is paying you a 5% cash flow starting, and it's going to generate let's just do conservative 15 overall return. So you're getting 10% of overall appreciation per year. In 10 years, that $1 million will be worth $2 million, right? And let's just say it's 5% for the duration for easy math.
Easy math.
Yeah.
Sure.
So there's 50%, 5 times 10, that's 50%. So you made $500,000 cash flow during that time, to which you pay no taxes on because of depreciation. But let's go back to this year, right? 2025. When you gave your CPA that $1 million of year one losses, that just saved you, let's just say like a 40% tax bracket, right? Like, or we could do 30, a third. It doesn't really matter.
300 to 400,000.
Yeah, $300,000 to $400,000 you just saved on your taxes.
And if you don't use it all in that 1 year, it holds, and what they call it loss carry forward. So if you get a $300,000 savings on taxable income, and you only need to use 100 of it, then 200,000 of the 300 is going to hold on your tax return for the following tax year to cover next year's taxes. Now, passive income, which is different. However, when you're a real estate professional and have the designation, whether it doesn't have to be both husband and wife, it has to be one of the two, it will cover and shelter ordinary income and passive income. Which is the magic and why we love the real estate professional election so much, because it covers both types of income.
And then to sprinkle a little more magic on the second year. So on loss carry forward, if you don't use all, like let's say your net wasn't $1 million, like you had the $1 million to invest, but you really only needed to shelter $500,000 in income that year. Now you've offset that, but now you carry forward $500,000 into the next year. Well, that next year loss carry forward can offset California and capital gains.
Yes, it can.
So there's a longer term, as you get further and further into this, there's a reason to sort of intentionally store passive losses into the future years.
Especially if you know you're going to sell a house or do
sell
something
business,
that's going to
there's a lot.
require
let's just
capital gains tax.
Let's just unpack that just for some clarity, because you said capital gains, and sometimes people, I don't want to confuse what you're talking about to selling another investment property and creating capital gains, right? So what Blake's talking about is this loophole in the tax strategy where if you use carry forward depreciation, you could wash, if you're a real estate professional, wash stock gain. So capital gains on, say,
or the sale of a property,
or
but
both. or the sale
gains.
of a property. But I think where the magic comes in is the California taxes. And then it's the stock gain, right?
Is it stock, bond, treasuries, like any of those that spit out?
Well, it's capital gains on a sale of a stock, which
has a gain. Any gain that you make in a stock then is taxable when you pull it out. And this type of loss would shelter that type of income.
Because we're in California, it would also help with that gain in California, 13%.
Right.
It's most of us are having a hard time dodging.
And that strategy right there, that's like 3.0, right? And so when I
Right.
first heard that, and I was, obviously speaking with the CPAs about it, that is, that takes some planning, right? That's 2 years of planning, or at least, it's roughly about 2 years. It's 2 tax returns of planning that you need to then plan. So say, I'll give you an example where this can make sense, because this is a real example. I have a buddy who works for SpaceX, right? Gets a lot of stock options.
Yeah.
And he has to pay taxes on those stock options, regardless if he sells it or anything. Just holding it.
Pre-IPO, they incur gains and have to pay taxes just as the stock price steps up in value.
Exactly.
Like appraised value, or however that.
Exactly.
Yeah.
And they're
heard that?
Oh, I
It's
didn't
horrible.
realize
It's terrible.
that.
Yeah. These are gains that you haven't even realized that you pay taxes on.
Unrealized gains.
Correct.
Wasn't that like a huge controversy with the Harris administration?
But that's regular stock exchange stock. What you're talking about is like, you own Tesla on the New York Stock Exchange, and then it goes up and you're paying taxes on that increase, even though you didn't sell.
Right.
But pre-IPO, it's always been that.
Yes.
Oh, that's terrible.
Okay, wait. So if you're paying pre-IPO taxes and you sell and there is a gain, is there no tax because you've already paid the gain? Or is the gain on the difference then from what they valued it to what
it's
you
hard to
sold
sell, because you're
it's not
pre-IPO.
okay.
But there are these newer things, because I've looked into buying SpaceX because I think it's interesting.
Fun.
And but it's this big run around, and you go through a private exchange. You have to be accredited. It's a whole thing. So I'm sure when you sell, if you've already paid the tax at that price point, then sure. But it's at what the sale price is.
This was the problem that was brought up, right? And I'm talking, and I'm like, well, you guys own a rental? Yeah. And I was like, okay, well, and they're having their first kid. And I was like, the wife was also working, good friend of mine as well. I was like, well, I don't know a lot about it, but I'll connect you with someone, a CPA that could chat with you about it to get you guys on the plan. If you're thinking about her being the stay-at-home mom and she's a real estate person as well. So she would love like just managing all their deals. Personally, you keep working, and then you could qualify for the real estate professional, right? And then start to invest in our deals. And then you could don't utilize the depreciation in year 1, carry forward into year 2. And then as he sells stock, use that to then wash the gain.
Right. Which, to your point, I just want to add something really quick is you don't have to use the losses, right? You
Correct.
just said you can hold them and move them to the second year or third year.
Here's the planning. You buy an asset in 2025. You don't utilize the depreciation in 2025.
Let's say you borrowed money to buy that asset.
Correct.
Now you don't really have anything to wash.
Well, then you buy the asset in 2025, you incur the loss, you carry it forward into 2026. You sell the stock in 2026. You need to be a real estate professional for 2025 and 2026. You sell the stock in 2026. You use 2025 losses for your 2026 tax return. That's it. That's exactly the planning that I was talking about, which is multi-year.
Well, and if you bought something in 25, then you wouldn't necessarily need the losses. So then they could carry forward if you weren't able to save them. But I thought there was a way you wouldn't.
The only way to
to
kick them forward is you don't need them.
I think.
It's just a calculation.
Yeah.
I'm almost positive.
People want to use them to minimize the taxes.
So like if you had if you were a real estate professional and you had a lot of gain, but then you wouldn't want to trigger gains that year. If you were starting from scratch and you knew the variables, like sometimes you get hit where you don't have the control of a couple of variables and you end up with a gain. But if you had control, ideally you'd like find other sources of capital, you borrow the money, whatever, buy that real estate asset or invest in a deal like ours to incur that depreciation, passive losses in the year before you have a gain.
Right.
To his point.
Yep.
But yeah, I don't think you can make decisions.
Yeah.
It's more about like when things hit and become when they're placed into service.
Gotcha.
Yeah,
that makes
whether
sense.
you sell or buy or whatever.
Right.
Yeah. Now we're going pretty deep, and it's like I just wanted to put another disclosure out there. We're not CPAs, financial advisors. We're just throwing.
We have really great CPAs, and we don't pay a lot of tax.
A lot of this is just chatting through ideas. Brainstorming. We're business owners and operators, and we're conveying this to other business owners and operators. Sometimes, I think it's funny. Occasionally we bump into people and they aren't even thinking about taxes at all. right? They're just working, they're crushing it, and they're getting hammered at the end of the year. And they're like, gosh, that really sucks. Once a year, my life sucks.
Yeah. How do I do that and not pay taxes?
It's not like a huge number, but I've had conversations with people. I'm like, what? So are you paying tax? It's like, well, yeah, but we don't look at investments based on taxes.
Yeah.
Well, are you paying a lot of tax or not?
Should.
Yeah.
You know, like it's kind of a yes or no question. If you're paying a lot of taxes, then there's obviously some strategy. Not saying you should go all in on a given strategy. There's probably a strategy that you could start to reduce taxes,
right?
But also earn revenue and have a real asset that pays you cash flow that's tax efficient.
Okay,
so we're not going to look at that tax benefit.
We go for 30% IRRs only.
I think we circle back because
and
we
pay
were talking
15%
about
taxes on it.
depreciation and cost segregation reports and what that is.
Yeah.
Right.
So
we've hammered this, but I'll hammer it.
Yeah, hammer it again.
So real estate and different real estate assets have a different format from an IRS regulatory standpoint, where depending on the improvements on the dirt, so the real estate's the dirt, and then you have improvements. Mobile home parks are really a real estate asset where you're owning the dirt, the real estate, and infrastructure. Well, infrastructure is technically mechanical. So when it's mechanical by nature, you're gonna have a cost segregation study done, and the IRS allows mechanical functioning parts and infrastructure to be depreciated on under 15-year depreciable basis. So in broad strokes, mobile home parks are typically 80% of purchase price you're allocating to the infrastructure, which is therefore under 15-year depreciable. And then something like a multifamily or industrial building, you have significant ownership of improvements that are concrete, steel, wood, stucco, you name all of the parts of a multifamily asset. And so you end up having a serious percentage, like 70% above the 15-year, in between 15 and like 27 or 30-year schedules, and then only 30% of the purchase price is under 15-year. So it's just an allocation game of the cost segregation study per the way that you are able to
spread out the
costs on the amortized schedule.
And mobile home parks are unique because when you do a cost segregation report, 80% of the total value, like if you're going to buy a property for $10 million, right, typically 80% of the purchase price falls under that 15-year mechanical, because it's infrastructure, meaning roads, underground piping, things of that nature. That's mechanical.
We just double whammied that.
Yeah.
But like, it's totally common sense, right? You buy a multifamily deal, it's one giant building. You buy a trailer park, we don't own the homes, right? We own the land. You're running the land. So it totally makes sense that a cost seg would do that.
And then let's just run the math really quick, because someone says, okay, Ben, 80% you just told me, Blake, times 100 is 80. You just told me if I invest $1 million, I get $1 million on losses. Right. How does that work?
We're not raising,
you add mortgage or leverage or debt, whatever word you want to pick, onto the property. So say if you buy...
I got a good one after this.
Yeah, okay, I'm ready for it. Say you buy $1 million asset and you put a 50% loan to value on it. For $500,000, you own $1 million property. So that's how you can get more losses than equity you put in, is because you're buying more purchase price than equity you're putting in through debt.
So yeah, let's break it down. I'll do a clean example of an apartment deal in a mobile home park. $10 million purchase price on a mobile home park, 80% or 8 million is towards the under 15-year bucket. So right now, that like with the bonus, we have to also disclose,
assuming that the 100%
with the
bonus is back
depreciation
in play
for 100% of these types of assets,
which hasn't passed yet. It's at 40% currently.
So as I'm going through this, I'm like, well, technically it's not yet, but it's close.
Yeah.
So anyways, 8 million at that moment, when you buy that asset, 8 million, doesn't matter how you bought it, how much loan proceeds there were, whatever. It just is the purchase price of the real estate. Mm-hmm. And it's 10 million in this hypothetical, and then $8 million is under 15-year. Okay, so you have $8 million of, in this case, bonus depreciation in year one. So then you divvy that up. Well, the investors, let's just say we get a 50% loan to value, $5 million of cash, $5 million of loan proceeds. So now you have $8 million of loss to offset $5 million. And so how it works is it just goes to that 5 million and then pro rata share the owners from there. And it's
the 3 million remaining.
correct. Because it first goes to the equity and the cash. 100%. So all of us would get full coverage, 100%.
Which is how they're getting 1-to-1.
Why Ben's saying, if you put in $1 million, you get $1 million. Okay. But then with this bonus coming back into play, what we're saying is it could go into another like 20 to 30%. You might end up with 1.2, 1.3 worth of loss on a given deal. And so that's really like the goal. I'd call it the hidden secret of mobile home parks. I mean, I bumped into a guy where he literally thought it was a secret, He's like, wait, everyone knows this? I thought it was a secret. And that was real life. So then you have an apartment deal. Okay. Same thing. $10 million apartment deal. You same scenario, 50% leverage, 50% cash. So you have 30% under 15 year. So that's 3 million. So now you're only on your $5 million of equity, you're only going to offset 3 million. All 3 million goes to the cash investors in that case. And so you're limited to, what is that? 60%, 65%. Mm-hmm. And so that's like just down and dirty, the quick example. So on a bonus year, like for the next 5 years, if it passes, we'll have 5 years where we're double the amount of depreciation, which means the double the amount of tax savings on a given 100K or a given million. And then our IRRs and our returns, I'd say, are strong multifamily returns. Like if you're buying core assets in multi, we're probably a nudge above on returns. Yeah. So now you get more tax benefits and more just all around appreciation and cash flow.
So what do you guys think? I think we should touch on also, like, if somebody was not able to qualify for the real estate professional election, can they, like, it's our understanding that they can still take advantage of these losses, not to the extent that we've been talking about in the last few minutes, but Ben, explain how that would happen.
Yeah. So it's not, if you don't have to be a real estate professional for this to make sense. Right. It's just, that is kind of like we're going in tax planning 3.0, but let's just say, hey, I want to invest. Tax planning 1.0.
Let's go back to that for just a second.
So let's go to Connect 4 version.
Yeah. I like that. If you just invest in mobile home parks, so you're not a real estate professional,
and
why
you're
would
a
you do that?
W-2 earner that has extra cash that you want to invest in real estate. What does that look like?
Yeah. The reason why you would do it is, one, for the returns, right? The stability of the returns. To Blake just pointed out, it's like you can invest in a bond or the stock market, right? And you can get a return, but anything that you, any of the income that it comes off, whether it's a bond, it's interest income, whether it's a stock, it's a dividend yield or dividend income, you're paying taxes on that. Mm-hmm. So if you're in a bond, let's just say like a CD, right? And it's giving you a 5%, you're going to go pay taxes on that 5%. So you're not actually clipping a 5%, you're clipping 3.5%, right? Maybe 4%.
Yeah.
And in real estate, you utilize the depreciation. You're not going to utilize all million in our example, right? But you're going to utilize that depreciation to wash all the income that piece of real estate produces. So you'll pay virtually no tax on the income. And really the way you look at this is a deferral game. And I think we should carry this forward and talk about 1031 exchange strategies.
Yeah. I think another way to say it too is, from a tax perspective, it's a return of your capital instead of a return on your capital.
Yep.
When you get a distribution or a cash flow dividend from a real estate investment that we're doing versus a bond or treasury or something like that.
And that's just one way that you, like, your CPA, when you have a firm, sets it up. So you're kind of, but even simpler, whether it's on or of, you have losses that shelter it.
100%.
Right.
Yes.
So, and it's because of the depreciation. So you don't pay any taxes on the income. And then when you go to sell, right, you're only that will bring down your basis, right? The income that you receive brings down your basis because you're sheltering. So say you put in $1 million, you got $500,000 of income over 10 years. Mm-hmm. Your new true basis is $500,000. So when you go to sell that property, you will need to pay depreciation recapture on the $500,000, which is roughly 20%, right? Tax rate. And then you'll need to pay capital gains tax on the delta between $1 million and whatever you sold it. Let's say you made another $1 million. Then you pay capital gains on the $1 million. But that's if you don't elect to do a 1031 exchange. So Blake, I'll pass it to you just because I was talking for a little while. Like talk about like this is a deferral game, right? Like real estate is not tax free, but there is a way to kick the can down the road to defer taxes. And that's what we elect to do on many of our investors through the 1031 exchange. You just want to go and like explain that and explain their structure too, of like deal by deal and not doing a fund structure and having the excess flexibility for these types of strategies. So
I'll kick it off with the fact that we buy a given mobile home park with a fresh LLC, or we're coming in from a 1031 ourselves with selling a mobile home park, and that LLC is now in an exchange, and then we're pursuing a new deal with that one. And so the exchanges are the best way to defer gain long-term and focus, I'd say, on the cash on cash portion of the return. And so like the name of the show is the CashFlow Quest. We are hyper focused on cash yield versus gain, because we can use tools like the 1031 exchange and continue to spool the amount of equity in a given asset, or go take a 2x return on a sale of an asset, and then move that money, which is now, let's say it was $1 million, now it's $2 million. Now you go buy something that's bigger, better, and spins off cash flow on the $2 million. So we are hyper focused on zero tax. And I mean, we solve for basically zero. I mean, if we pay 10 grand in tax in a given partnership, like in my opinion, I didn't do the best job. So we are hyper focused on the cash flow return on equity, which if you do 1031s and you play the game and you have the deal flow to do and execute 1031s when you need them and when you have sale proceeds sitting with that time frame in mind. So you have to move the money in, and when you close escrow on the sale, you have 45 days to decide and identify a property that you'd like to pursue, or a few properties that you'd like to pursue. There's a couple rules there, but that's the nitty gritty. And then from there, you have a total from the close of escrow of your sale. You have 6 months to put it in and close it on the up leg or the property that you've chosen to pursue and buy. And if you can get it all done in that time frame, which seems tight, but if you're doing deals and looking at deals regularly, typically it can be done. And it's also a fun way to I'd say get the deal flow mechanism within your business to kind of kick up into another gear, because when brokers hear that you have an exchange and you actually close, everyone hears about it, and so they start sending you deals because they know you have money burning a hole on a time frame and you're going to have to buy something. So we've had a lot of fun with that over the years. And so when you defer all that tax, now you buy a better quality asset, which now our goal is always to like 2x that. So it's $1 million, now it's 2, now we're going to take it to 4 over 5 to 7 years is kind of our normal strategy. We are able to do that completely tax-free. And the cash flow is tax-free until you're completely out of basis, which takes 20, 30 years. If you've done exchanges too, because when you go higher up in price on exchanges, you get the difference in depreciation, so you start to accumulate more and more passive losses that you can utilize.
He makes it sound easy, but we just got to point out, and I'll help you on your investor conversation side, is that is not easy to do consistently. And the fact that we do that, and there are other great companies that do that, I think that's one of the like red carpet services that we do provide. Mm-hmm. Like it's easy to sit here and talk about but most people can't find the deals in time or good enough step ups. Like you should pat yourself on the back. The amount of 1031 exchanges we've done over the last 15 years is a statement. It's hard, and it's part of why people come and do business with us, I think.
It's the big value we're bringing to the market is this tax planning strategy. A lot of 1031s, a lot of people that have rentals that really don't understand the real estate professional designation, how it can really offset. I'd say we have a firmer push to be like, hey, you could be a real estate professional. You just have to tweak this a little bit. Or it's like, you're in your groove. It's like, well, my wife doesn't want to work. It's like, can she just drive around and make note and use an AI tool to make sure you spend the 15 hours a week? It's like, that's all it takes, Yeah. So we kind of go through that. And then the 1031 is the ticket. I think that, in order to play the game on any level, you have to take that initial risk. And typically I'll have a line of sight or something that we're seriously pursuing as a new deal before a deal clicks through and sells. And so that's kind of, it's an engineering, feat versus like a crazy deal make, effort. It's more of an engineering game on timing.
Yeah.
And you kind of pull levers and then typically they'll let me on the sale end. They'll let me extend if I need to, or they'll be workable, or I'll tie up a property with some extensions, knowing that within that amount of time that we've just tied up the escrow for the deal we're pursuing to purchase, we'll be able to sell the deals that we'd like to sell in that time frame. So it's fun. Thank you for the compliment, Ty. But it's there is always like this structural Hail Mary moment where you have to like, we got to commit, close it, and then we're off.
And if you're a plumber or a contractor or whatever, you're probably like, that's not your gig. Do what, like Glenn, you always say, do what you do best, make money, and come with us as an LP and we can go on the adventure together and grow your equity.
And I think just to kind of put a cherry on top of this, that's a formal 1031 exchange, but there also is a lazy 1031 exchange, which is like if you're a plumber or somebody who has a rental that they want to sell and wants to not do this formal process of an exchange, within a 12-month period, you can sell a property like that and take the gain and invest it in something, the cash, and hopefully the bonus depreciation 100% comes back. It still would work given current laws, but it wouldn't be as juicy.
Well, that just depends on how much gain.
Exactly.
And
there's variables to that.
The key is to have it held as a rental property. So then it's actually a passive gain.
Right.
Mm-hmm. Mm-hmm.
Right. And so that would work too. And that's an option for people that maybe don't want to go through that formal process or don't have
and sometimes it doesn't economically make sense.
Exactly.
If it's like under $1 million and depending if you bought it a couple years ago, so the value hasn't improved that much.
And it still has to be right kind. There's still rules to that. But it is an option that I think is a good one for a lot of people.
Oh, we love that.
Yeah.
We love the lazy.
Exactly.
Also, nothing again,st plumbers. We love our plumbers out here.
Yeah, that was just I
thought you were going to tie it back to like at some point you got to cut the water off and replumb a fresh line. I thought you were going to go somewhere
towards cash flow.
At some point, you can't flush the toilet anymore because I got the main cut off.
Yeah, and like the lazy 1031 exchange strategy, just because like as we're talking now, like I'm thinking about all the questions I get on a day-to-day basis.
What else do you hear?
Well, one thing just on that, it's not like you sell and you reinvest in the same year. You don't pay taxes like as soon as you sell, right? You file for taxes the following year to pay, last year's tax bill. And so the simplest way to think about it is that you sell a rental property and within that same year, like you're saying 12 months, but it needs to be in the same calendar year. So
if you sell in June, you only give yourself 6 months. If you sell in January, you got 12 months.
And if you
don't sell in October and November unless you know exactly where that money's going.
And you can reinvest into anything, but mobile home parks or like a gas station or a car wash, something that has a lot of equipment, that's real property, is going to provide the most year one depreciation. And so what you do is you create a gain, but then you reinvest within the same year to offset with a loss, paper losses, depreciation. And then that helps offset your gain. And it works on the federal side. So you could most of the time, depending on where the bonus is, if it's 100%, you could always bet that you can clear all your federal gain.
Right.
As long as your capital.
To be more specific, it's federal gain, not state gain.
Yeah. Well, we're in California, right? So California just doesn't recognize it.
Yeah.
And that's the way that you kind of get around that. And you're like, it works great for people because every time someone sells something, they know they have to pay taxes. But then when you educate them, you're like, well, what's important to you? And it's like, well, I don't want to pay that much taxes. And I actually like cash flow. I actually like real estate.
Yeah.
That makes the most sense. And it's like, well, then just reinvest it, move from being an active owner, go to passive, let us do all the work, save yourself a couple $100,000 on the tax bill.
Right. And
call it a day. You're going to get all the same benefits without any of the ownership or responsibilities. And so that's why we call it the lazy 1031 exchange. It's not really a 1031 exchange at all, but you have to give it some sort of name.
Call it that. Sure. Yeah.
So, and it's a great strategy that has come about because of the cost segregations that you can do, and then the bonus depreciation that was brought into effect in 2017.
Right.
Well, I think we hammered tax I think we touch on if you're an employee W-2 person, maybe you're still single. So like the whole spouse thing doesn't come into play for the real estate professional. What are some tax strategies?
Okay, so one thing I would say outside of real estate, just other things that I'm a huge proponent of, Roth IRAs. I think that everyone, especially if you're a young person, like max out your Roth IRA every year. I mean, it is
So that $6 or $7 grand. How much?
I think it's 17 grand you
Okay.
can put in a given year.
It was 6 or 7 grand when we were like graduated high school. I think it's like come up pretty drastically.
Okay.
Yeah. So definitely like max out your Roth IRA because you pay taxes on the front end, but then it grows tax free. And then when you pull it out, it's tax free. So it's just an amazing strategy. I think if someone tells you not to invest in a Roth IRA, don't listen to them.
What does a Roth IRA invest in? Like, how does the money there make money?
It's whatever you want to invest in.
So you get to pick. It's self-directed.
Well, I mean,
They're probably
that's
different structure.
So, I mean, it depends. So say you work for like an employer, right?
Yeah.
And they will generally, when you go and elect, hey, I want a Roth IRA, I'm going to contribute 6% of my paycheck every month into the Roth IRA. They generally have like a menu of things. They partner with other groups, Invesco, BlackRock, Vanguard, whatever it is, right? And then you kind of say, yeah, check the box. I want growth, stability, whatever it is, right?
Right.
That's generally how most people do it.
Okay. That's what I've seen too. I just thought I'd ask.
You can say if you're a business owner, right? And you could set up your own Roth IRA and you could put cash in it. And then you can go on your Charles Schwab account or whatever it is. And then you could buy whatever stocks, ETFs, bonds that you want. You can even use your Roth IRA to invest in real estate, or you can invest in venture capital or whatever it is. So the options are limitless as far as like what you want to do. It's all about structure it's really the wrapper that it's in, as far as like where it's held. And that's really going to give you the rules of what you can invest in is as simple as I could probably make it.
And then any gain that's made from an investment goes back to that Roth IRA.
Yeah, you have to keep it in the Roth.
You have to keep it in the Roth. So if you make an investment in real estate, then the distributions would then go back into the Roth IRA until you're then going to take distributions from the IRA account.
Yeah, like here's an example for me, right? I've invested in lots of different types of deals through my IRA. I basically only have a Roth. I kind of backdoored all of my traditional, IRA. It's like a 401k, but a traditional IRA, right?
Sure.
I backdoored it into a Roth. I paid massive amounts of taxes on that.
The money that was in the IRA that you moved to Roth.
Yeah, because because a traditional IRA is tax deferred. You don't pay taxes going
until
in.
You pull the money out.
Correct. Yeah. And so I decided I don't really like traditional IRAs. I think, like, do you think taxes are going to be higher or lower in 40, 30, 20 years?
Yeah, probably.
They're going to be higher, right? Yeah. And so I would rather pay my taxes now and then have that be tax-free down the road. Sure. And so I backdoored it. It's a way that you can get above your $17,000 threshold that you can put it in a given year, but you go and pay taxes. But it has to be in a traditional IRA in order to do the backdoor maneuver. All right. And then I've invested in deals. And so like real estate as an example, just because I think this is a really good point for probably the listeners. I've invested in real estate deals through my Roth IRA.
Yeah.
All the cash flow goes back into the Roth IRA. Right. I then let that cash flow build up because it's not a ton of money. Right. And then I then move that into, because it's in a self-directed IRA, I then move that into my other IRA that's with Charles Schwab.
Regular IRA, not a Roth IRA?
It's a Roth.
Oh,
Roth.
Okay,
Roth.
Roth.
Yeah, so then I move it to my Charles Schwab Roth IRA, where I use the cash flow that builds up to then invest in stocks, right? Because I want to keep the money going.
Sure. Okay.
When those properties do materialize and sell, I don't need to participate in the 1031 exchange because I'm not going to be taxed, right? And so, but I like having it, I'm invested in good deals. And I like it in there. There are deals.
So even the gain from the investments going into that are tax-free.
Correct. So then boom, I created my gain. I sold. I choose not to participate in the 1031 exchange because I have no need to unless I really want the next deal. It's a great deal.
Sure.
But then I can take all of that.
You have optionality.
You have options. Yeah. And then you can move that money into going buying stock or invest in another real estate deal or invest in venture capital or do whatever you want.
Sure.
So I think it's a fantastic strategy to do. money in a Roth is very, I think, valuable. Mm-hmm. So while it's not taxed, you don't want to throw it at dumb investments.
Yeah.
Because it's very hard to get money into a Roth. And so once you have money into a Roth, I think it's better to invest in really stable, like real estate. You don't want to do anything too speculative, right? Even though there is the double-edged sword that if you do, and you invest in something very speculative, like a venture capital investment, if you invest $100,000 and it turns into 30 million, you have no taxes on that money. You got to wait till 59 and a half.
To draw it out.
But if you lost $100K and you don't have any way to backdoor it, it's going to take you
17,000
5 years.
Year
it's going to take you 5 years to get it back to $100K.
And what he was talking about, when we're talking tax deferred accounts, it's 401k and your traditional IRA account. And I think that like, what's funny is a lot of people, that's like their full, like
retirement plan.
Yeah. Their full retirement plan is the one we don't recommend you do. Right. Yeah. You're looking at the My Money guy, Keith, shout out to Keith, the tax triangle, right? It's like, obviously we're looking at taxable when we're talking real estate. We do some neat things to avoid the taxes in our specific class. Mm-hmm. And then what you're talking about is a tax advantaged account, which would be your Roth IRAs and things like that.
Oh, I remember.
Also back to what we were talking pre this conversation, another tax advantage account would be like life insurance, so full life, things like that. Tax vehicles.
Are Roth IRAs liquid? Can people once you put money in them, can you draw from them?
No. Until you hit a certain age.
So now you have to be 59 and a half to draw anything. So once the money's in, it's there until you're 59.
Well, I think you get punished if you do take it out.
Okay.
And there's also a couple.
You can take it out, but you're
penalized.
You're going to pay penalized.
There also are a couple other ways you can take it out, like for specific reasons. I think like if you're a first time home buyer, I think maybe college tuition and then medical bills. Don't quote me on this, but I think there's like a few. You
could lend against it. So what you do, I did this when I first bought my house back in 2021. You could borrow money from yourself from a Roth or a traditional IRA. And then the interest is what you pay back to yourself in that IRA. So you actually have to then pay back that loan amount. If you don't, then that also incurs the tax. You have to then pay taxes on it. And it's usually a 10% penalty if you pull it out. And then in a Roth IRA, if you pull it out before 59 and a half, you actually pay capital gains tax on any of the gain. You don't pay on what you put in because you already pay taxes.
I was going to say, you're paying a penalty. Because you're basically choosing not to defer now long term on the gain.
Correct.
Right.
So it's not tax because you're paying after tax dollars into a Roth.
Right.
Yep. Yep. So there's kind of a lot to talk about there.
Well, I think, just like a governmental philosophical point is when these laws are put into place, it's really to help because they know that citizens that are doing these things, like if you're putting money and saving it in this Roth, I know that they probably get money off the float, but long term, it's a good thing. This means you're going to have a good, strong retirement, compounding interest. It's good for the people. Same thing with the 1031 exchange. They want to grow. They want to see people investing money into real estate in the American economy, growing wealth. These are benefits to the country. So
it's reinvesting back into the communities,
keeps
right?
Keeps the money out there versus stashing cash.
Yeah,
correct. Or blowing cash on frivolous things.
All right, so let's hit on the life insurance topic. There's a different type. So Tide, go ahead, explain.
Yeah, I think life insurance is a wonderful way to help shelter money and also do some smart tax advantage things. Maybe you have some inheritance that came from a Roth. If you get inherited money from a Roth, you have to spend it within 10 years.
Mm-hmm. No matter your age. Yeah.
Yeah. You have to get rid of it. So, something you could put it in is a full life insurance policy as a way for some tax advantages. There's also, it's just really neat. I think everyone should have some form of life insurance. My in-law, he passed away and luckily he had some term life insurance. It's a beautiful thing to give to your family if something happens that you were prepared thinking about them to help with funeral costs and whatever, if they're now, somebody who isn't working and they're losing that revenue. So I think it's important. And I think there's a lot of really neat, it's almost like a forced savings account that's also growing compounding interest if you're doing some of these full life. Mm-hmm. There's also a lot of legal ways that you can kind of help stow away money for your future generation, for your kids, through some of these things. So yeah, I mean, I'm not the expert.
So you got two main two main products. You got a whole life policy, which has a cash portion too. So let's just say you wanted to buy $1 million of life insurance on yourself for your family. It's benefit if you die. You end up paying for the coverage plus an amount that you're comfortable saving per month. Let's say it's $1,000. Spending $200 to $300 on the coverage cost of this. And then the rest is going into the life insurance policy, the whole life policy, and it has a cash value.
Which you can borrow against and use.
It's just a good way to put away money and for savings is a good way of saying it. And that way, like I'm personally not like a good force saver without these. So then you use these as force saving tools that have a coverage component. You can tailor the coverage and the cash value one way or the other, depending on what you're after. And then you can buy life insurance policies on your kids, each one of them, and you can save money on their behalf. And so there's a lot of fun ways that you can force savings for the future in a whole life. Then term is you're buying like for business oriented stuff. Typically you're buying term because it's a lot cheaper. And term life insurance is you're just buying a set dollar amount of coverage on a given person for an amount of time. And you're just paying a premium. You're not setting aside cash.
For 5 years or 10 years. And when the 10 years is up, the coverage goes away and you've paid your premium. It just expires.
And we joke that we're going to buy life insurance on Ty just in case he kicks the bucket.
If I die and Blake shows up in a new hot rod, there you go. There you have it.
It's really so I can hire a COO. In theory.
Yeah.
He thinks I'm going to kill him.
Yeah.
Well, it's kind of weird when you come down and everyone's sitting talking, hey, we were just talking about life insurance policy on you.
We got your blood tested without you knowing. So anyways, those are the two main things. And then as you get into it, we're learning that there's perm term, you can own term, but it's permanent term, so there's a whole bunch of stuff.
The two big ones though are whole life and term life insurance policies. So those are the most common, but
I will say, if you're a family man or a family woman, it's not a bad idea. We lost our dad in a quick manner.
And he was
a heart
too
attack.
Stubborn to have any life
and
insurance.
He didn't like how expensive it was when he was, 60s and into his early 70s. So we were like, okay, well, hey, he's probably going to be around for a while longer. And so we learned the hard way how much things cost, to buy the gravesite and the casket and throw the big fun party, it's real money. And
to just add, I think a lot of employers are starting to offer life insurance and you can pay for it with, before taxes. So you can always talk to your company or your employer about that. We were looking at that to offer as a benefit for our team. I actually think we do
have some supplemental that they can do.
I think we just put it into play. Yeah. And so that's something that could be available with your employer, just as, not every employer does it, but sometimes it's an option. Yeah.
Yeah. Very
awesome.
Cool.
So then last thing, just to wrap up on more of a fun topic. If you want to buy a hot rod car or a plane or something and you want to do it in a tax efficient manner, we've had some experience with this. So airplanes are great. You can actually bonus depreciate them. So with this bill coming back, if you've ever wanted to own a plane, wanted to fly, you're a pilot, you wanted to do, there's a whole world in aviation. And most of people own planes in LLCs because that can create that loss, or that you can bonus depreciate an airplane in the first year. Yes, so that's, you can spend real money in airplanes, so you can get a lot of loss. And so that's where most aircraft, literally most private jet aircraft are sold with a tax mindset. Literally, I think Gulfstreams are priced based on the tax game. Like a $70 million Gulfstream G700 or whatever. Like it's these big corporations buying them, using them as the bonus, writing them off, and all of that, expensing it. And then the average hold on a Gulfstream is 3 years to do it again. Right. So there's the big picture. Now, if you come back down to like a fun car, if it's a car and it's under 6,000 pounds, you're better off leasing it, unless it's just a car that doesn't lease well, or you're buying an older car and you'd like it for more of an investment, then you should buy it. Right. But you could still own that in an entity so that you can write it off or put your logo on the side and use it as a company car.
Right.
The rule of thumb is your family should at a minimum have one car in your name.
Mm-hmm.
And then the rest can go in your companies.
Mm-hmm.
And so like all of my I have a Bronco and a plane. I run all of those through my S Corp or an LLC, and it's leased back to my S Corp. And that way you can write off all of those things along the way, but it's also an asset. You know, I list an old Bronco that's all dialed in on my financial statement. Like it's something that
it's a value.
is going to hold its value for the most part, you know, and you can use it and you can write off the gas and all the stuff that goes with maintaining it. So there's ways to do it.
And it makes you feel better when you buy a nice car and it's not like you just blew the money. It's sitting there on your balance sheet.
Yeah.
Yes. I like, cars that are hard to replace. That way, you know, the values hold. So anyways, any takes on that? Any fun stuff?
Well, we're talking cars under 6,000 pounds, so most sports cars. And I think if you cash flow and invest and do some kind of model like we are and get into positions over time, eventually you can just buy them cash if you get to that point, you know, like you're not, I feel like when you're first starting out, there's all these like, oh, how am I I'll get the Range Rover or whatever so I can do the depreciation. But eventually the cash flow gets so big when it's in third and fourth positions where it's like, I'm just going to get this one. It doesn't even have to go in. So grow the money.
Compounding growth.
Yeah. And don't sweat the small shit.
Start as early as you can.
And defer taxes.
If you're young, get in the game now.
Yeah.
And don't spend every dollar you have. I think too, like when you talk about CashFlow Quest and passive income and what we do, it really comes down to like financial freedom. And so you really need to know what your budget is, what your monthly burn is of your necessities and, maybe your wants, and try to live under that. And then it doesn't matter. You could be only making, I don't know, $50,000 a year, but if you only spend $30,000 a year on your expenses,
$20,000 a year,
you are financially free.
Yeah.
You are not beholden to anyone, and I'm talking about
allows you to really play the game.
Yeah.
And set a target and
small.
make moves to achieve it.
Exactly.
I think my first checks coming from deals were like, maybe $100, $60 to $100. And I was making 60 grand, 55,000. And it took time. It takes a lot of time to get the money really churning and going. And that's, delayed gratification is the key to success.
Yeah.
I think. 100%.
Slow and steady. Yeah.
100%.
Well, hopefully you learned something, listened to this, and got some ideas to go talk to your financial advisor or CPA about. Cheers, guys. Thanks for tuning in.
Thanks for joining us for another CashFlow Quest. See ya.